Good evening, everybody. All right, tonight we've got the great pleasure of having Price with us back again, and he and I have gone back a long way. Price is probably one of those that I put in the top echelon of technical traders in the nation. Number one, and probably just as important, is when he tries to teach people what he's doing. It's not that he's showing you what he's doing and you learn it. He's one of the true teachers that wants to make sure you understand what's going on in the when you're analyzing charts. So with that, as you can see, I'll even Price is usually on CNBC, Fox News, Bloomberg. I mean, you see him quite often. So Price, we're once again glad to have you here at the Candlestick Forum, and very anxious again to see your information.
Oh, well, thank you, Steve, and good evening, everybody. Glad to have you with us. I'm in Lexington, Kentucky, and I've got my lead consultant and associate, Chris Sarin, with me to help answer questions through the chat box. Definitely look to get you interactive throughout this session, and also feel free to chime in with anything that's on your mind as we go. We'll try to get to a lot of questions either during or especially towards the end as we wrap it up. But I do have a lot to share with you. You know, earnings season, the official earnings season, is actually kicking off here in early July. We usually consider Alcoa, the Aluminum Company of America, which used to be a Dow stock, no longer is, ironically, but it's announcing on July the 8th. And so, you know, typically we want to get ready to start trading earnings strategies into that prime season because, you know, after the end of this second quarter, hard to believe that the half point of the year is almost upon us. But at the same time, there's a lot of opportunity created around earnings. But you've got to know what you're doing. You can't just blindly go in and just try to buy an option in front of earnings. In fact, that might be the worst thing that you can do because we're going to tell you why here tonight. Just as a quick reminder, of course, everything I'm going to share with you here tonight is geared for information and education only. Nothing that I talk about should be considered a specific buy or sell recommendation here tonight. Just consider this purely educational because I'm always concerned about if I talk about something I like on the way in, you might not be around unless you're one of my subscribers for where I'm getting out and recommending you get out. So we'll walk you through that. We'll look at current markets, and we'll keep it moving quickly because I've got a bunch of slides and examples to share with you from 2015. Now, of course, ultimately, you know that you are solely responsible for any decisions you make, any trades you make. That's on you because ultimately you know what's right for you, what's not right for you. Big Trends doesn't provide personalized advice of any kind, so you should consult with your tax advisor before you make any investment that might impact your unique financial and tax situation. All right, so bottom line is we talk about the 3 E's, making your trading easy, if you will, but bottom line is, bad pun, I know. I want to get you pointed at the target. A lot of people I see are totally pointed in the wrong direction, have no chance to hit a goal because they're pointed so far off into the woods. You know, we want to get you pointed at the bullseye and the target, and first step is getting you oriented in the right direction through education. That's what we're going to do tonight. We do a lot of teaching as it relates to the scanning process, and that's where we go into whittling it down through exploration and scans. And then it's about having very clear-cut, specific execution tactics to know exactly what strategy you're going to do, at what price point is acceptable, what's the risk-reward ratio like, and then pull the trigger, let that arrow go, and seek to hit the bullseye. And with that kind of focus, it's almost like you can tunnel in and really get a lot more effective at weeding out, frankly. A lot of good trading also goes back to getting rid of a lot of what you shouldn't be doing. So a big part of what I'm going to share with you as it relates to earning strategies is things that I would say you should stay away from. So we'll talk about some of my favorite big trends indicators and techniques I've developed over 25 years of trading to really take advantage of earnings season volatility, both before and potentially after the news. A lot of people just think about trading before and trying to take advantage of that gap, but that's not the only thing you should be doing. There's a lot of continuation moves. You can trend trade after that gap too. So we'll talk about a systematic approach for entries and exits and really focus on very specific examples of trades that we were calling out live for our earnings students and how you can become an earnings boot camp student. My newest boot camp just launched to get ready for this earnings season and convert that knowledge into results as earnings season's getting ready to really officially crank up. Even though there's a lot of reports actually happening, even as we look ahead over the next week, you've got big names like Nike, for example, coming out later next week. So there's always going to be opportunities in between the classic earnings season, but the primary season, the battle between the Bulls and the Bears, really takes place 4 times a year, typically after you get that quarter behind you. And, for example, after the June quarter is over, the end of the second quarter, then you see a lot of those reports come out in the second and third and fourth week of July. The same thing in October, same thing again in January and April. So kind of rotates on that cycle, but that's where you're going to have the most opportunities, but you're going to see opportunities actually each and every week. It just depends. Last week we only had one in Lulu, and I'll talk about Lululemon is one that we traded and cashed in on, as well as some other bigger ones that we hit, like AOL right before the Verizon takeover, and how you can essentially buy options cheaper with this special strategy I'm going to start to introduce you to here before we're done tonight. Now, the idea is that volatility can be an option trader's best friend. Most of you think you want big volatility when you trade an option. I've said that sometimes you want steady trending characteristics in the stock or market, and those are some of my most profitable markets because they actually are very cheap options that you can ride trends on, and the moves last a lot of times a lot longer and a lot bigger than people expect. But you've got to, if you're going to trade volatility into earnings, you've got to know how to manage that. You've got to put the odds in your favor. Just out of curiosity, if you've traded earnings, I'll just ask you a quick question. Would you say that you tend to like to buy options in earnings and play for the big home run? Would you say you'd rather sell premium and sell options in front of that, which has its own risk if you get a big gap against you? Or do you tend to want to kind of stay away from earnings season and pass on it and just wait to see what happens after the earnings? So some say home run, say a few more say sell, and a few say pass, okay? But it's a mix, okay? So you can see from responses, and not a clue. I'm going to share with you, I appreciate the frank response there, one and all, because I'm going to share with you how, to me, you can set up trades to really create a huge, very wide window of profit opportunities, and then you've got to get a really big gap against you or a big gap way up in order to see the trade that I'm going to share with you start to run into trouble. So you really start putting a wider range of opportunities in your sweet spot, in your profit zone, versus the rare occasions where something might move 20% up or down, and then, you're going to have to find a way to manage your way out of that, and we'll even share with you how we do that, too, to limit the damage. That's good trading in general, right? Cutting your losses if you're not on the right side, but trying to get strategies where you can put a wide range of scenarios into your profit zone there. Now, a lot of people might say, well, you know what, I'll just buy so far in front of earnings that I'll be out before the event. So at least on half or more, I always say if you're going to do that strategy, number one, that's not what we're talking about tonight, make sure you get, if you're going to buy, say, a month in front of earnings or even a couple weeks in front of earnings, if you're getting out the day or two before earnings, you better go ahead and get your risk capital back in your pocket. So, if you're only up, say, 50% on a trade, which is fine, it would be a nice little trade, you can then take 2/3 of your position off, get your original risk capital back in your pocket, and ride that remaining third into the event if you want to what we call free roll, that is, roll on the market's money. You've gotten your risk capital back in your pocket. And Richard, no, we're not really talking about credit spreads here, because credit spreads, ironically, I know it's a popular income strategy for a lot of people, but credit spreads for earnings don't really take advantage of the fact that all of the options are going to be expensive in the short term, and so therefore you're not really able to really sell high volatility and buy cheaper volatility. In fact, that's where we're going to get into my favorite strategy here in just a minute. You want to know a stock's history of gaps, and then you might say, you know what, if options look too cheap, I'll show you an example that I saw not too long ago in Apple, where I said to my subscribers options were too cheap in Apple, and you could have taken advantage of buying in front of the news because Apple is prone to have a bigger gap than what the market was expecting. That doesn't happen a lot. Most of the time, you know what happens with options right in front of earnings. They get juiced. They get really pumped up because everybody's kind of geared for some kind of a potential gap move. Now, you could buy a straddle, which is buying a call and a put at the same strike price. Say you've got a stock at 50. You could buy the 50 straddle, meaning you buy the 50 call and you buy the 50 put, and that's kind of expensive. It's actually twice as expensive as playing one direction, because now you're paying twice as much premium saying, well, now I'm looking for a big move one way or the other. I think that's a bad strategy overall, and I would encourage you not to do that. But remember this word straddles, because we're going to use the straddle pricing to actually determine what the market is expecting to manage accordingly. For those that don't know options as well, these terms like straddles and strangles. Strangles means if the stock's at 50 and you say, I don't want to pay that much buying the 50 call and 50 put, you could buy the cheapies. You could buy the 55 call out of the money and the 45 put also 5 points below the market, and then at that point you're not going to pay as much, but then you actually have to get an even bigger move with a strangle. So that makes the strangle a tougher play too. I'm going to come back to number 4 as my preferred strategy, but number 5 would probably be my second most preferred strategy, because once you get the earnings behind you, the earnings can become a catalyst for a trend move. So for you trend followers, and I do have my share of strategies at Big Trends where we like to buy premium. Typically we like to buy in-the-money options, but we've also got some aggressive techniques where we'll buy at or slightly even out-of-the-money options. If we find a really big trend starting to develop, you can really cash in on those, the leverage of a slightly out-of-the-money option going into the money. But that's for the continuation move. I'll show you a couple of examples of that before we're done as well. But the number 4 is actually my favorite strategy here. Consider a time spread. Now, what does a time spread mean? A time spread means, you know what, it's a calendar strategy. You're selling one particular expiration period, and then you're buying another. What happens with the shortest term options is those options usually are the higher volatility options. Those are the ones that really get juiced the most, because, of course, they have less time till their expiration. So the potential for a gap move, say a stock's going to gap up or down 10%, the potential for that gap move could create even bigger leverage for those shorter term, usually cheaper options. But you know what I've found is that usually they get too inflated, and as a result you want to position yourself to say, I'll sell that, but I wouldn't sell that by itself. That can be dangerous because it could indeed gap more than you expect. So at the same time that I'll sell those, I'll buy more time at a relatively cheaper volatility, a relatively lower implied volatility premium. Now, what does implied volatility mean if you're new to options? All it means is essentially what the market participants are willing to pay to buy or sell an option. If everybody thinks an option is too cheap, if I'm the market maker, you're going to run in to buy that option because you're like, that's a cheap option. I'll buy the cheap stuff, and then I've got to pump up the prices to meet to some kind of supply-demand balance. If it's too expensive, you're all going to go, I'll sell that all day, and you start selling. The market maker's on the other side buying and going, you know what, I got to bring these prices down to find that balance. Okay, so the reality is supply and demand tends to drive a lot of that perceived premium. Now, as I said, implied volatility spike often right in front of, in the days, usually up to a week in front of earnings. The market, everybody knows, anybody that's done any bit of homework knows when the earnings dates are for these companies. You can get it on a lot of different websites. And what you'll find is that if you trade the wrong option, you can get yourself in a lot of trouble. If you think of the stock's going to have a 10% move, and you buy, say the stock's 100, and you buy the 110 calls, thinking it's going to move 10%, and it only moves to 108, you were right about a decent-sized move, but it still didn't move as much as you expected, and that one's going to hurt you. So, you know, as I said, earnings can be a catalyst where you might hold into the earnings report if you've already gotten some profits, and if you book those enough profits to put that original risk capital back into your pocket. You know, this is an interesting chart here. It shows you, just looking back over some past quarters coming into and out of the earnings season, which I've got the earnings season here circled in red. You can actually see that sometimes right as we start the earnings season, like we were looking at here in early October, you can see that we were spiking to very high implied volatility. Options were very expensive coming into that October season. You know why? October, usually people are worried about an October crash or plunge. You know, so those are already priced for that, much less the fact that earnings were coming out. You can see sometimes during the earnings season, you'll see the volatility implied in those option prices peak, as happened on these other two examples. It peaked kind of about midway through. and then it really dropped off. And you can see if in each case, when you come out of the prime earnings season, look at what's happened to volatility. The expectations have gone from people thinking there's going to be a big move to now all of a sudden that's behind us. And if anything, that's a relative low point of volatility, as you can see on these charts as we get ready to then see it come back up. So the event risk being behind us means now that people start to assume that the market, the pricing of those options can actually get relatively cheap. You remember that because that's an opportunity that can come in coming after an earnings report. Now, when we talk about the types of risk for a particular security, there's market risk. There's going to be price changes for individual securities. That's what most of you are usually thinking about when you think about where's this stock or market headed. There's also what we call the systemic risk, which means that, you could own the best stock in the market, and if the overall market crashes, sometimes the best stocks crash even harder. So, just because you own the best stock, even if you're right about it being the best stock, sometimes those stocks can have plenty of risk just because of the overall systemic risk in the overall market system. Liquidity risk, can you get in and out of favorable prices? We tend to trade very liquid, active options and active stocks. We don't really mess with stocks that are usually trading less than, say, 1 million shares a day. It's just not worth it to us because at that point the options aren't going to be as active either. Now, there's political risk, as you know, with governments at home and abroad, especially abroad, it seems like, where you hear about what's going on in Russia, Ukraine, the Middle East, etc., and what that's doing to oil prices and overall markets as a whole. Now it's Greece and what's going on in the Eurozone, right? So every day is a new day over there. Bottom line is that, and frankly, our market has held up incredibly well, I would say, which is also a good sign for stocks. As Steve mentioned, I was on CNBC last week, and I was talking about that I was bullish on the market, and people were, including the main hosts, kind of commenting about why would you possibly be bullish on the market last Tuesday, the 9th. And I was saying because we're just pulling back into support, and you can see here for the S&P chart, SPY, we'll talk about some of these other indicators. We've been in the classic trading range for quite a while, right? You can actually see it if you look across here, and we'll say, gee, it really hasn't gone anywhere for most of the year. But despite that, there's been incredible opportunities in these earnings-based trades to make great money and control your risk in the vast majority of examples. And even when I've got a great earnings-based system like this, I know that I've got to not overcommit my capital. You can be making really good money on your strategy, and even some of the best and brightest on Wall Street have gone belly up because then they started overcommitting. They flew too high, got too close to the sun, and then those wings melted and they came crashing back to earth, right? We're going to talk more about what those charts mean and what we're looking at there. But, bottom line is that I was pleased that, the market's rallied since I was on CNBC, and, saying I was expecting that we're going to move to new highs and actually make a run of about 10% of the market over the next 6 months or so, which sounds crazy, but I think given the long sideways action we've had, don't be surprised if when we get a breakout, it could really be a powerful one coming out of a very long sideways period, base as we call it in technical terms. And then event risk, earnings can gap a stock. We want to actually show you how to profit from that here tonight. And then volatility, don't pay too much in front of earnings. Now, I mentioned before how, when I look at that straddle pricing, this is Apple chart going back here last year and seeing, okay, when Apple pre-split, it was trading up there at 530, and I was saying right in front of earnings that were coming out in that April period, that these options were incredibly cheap. This thing was trading at like $10, 11 bucks actually, between the 530 call at 6.5 roughly and the 530 put at about 4.5. So it was about 11 bucks on a 530 base. That was just over a 2% move. And I was saying, that Apple is prone to a lot bigger move than that over this period. And so we can actually position this to take advantage of this. Now, another example that I thought was too expensive in that same period, this is where I started to really get tuned into this strategy I'm going to show you, taking advantage of the 2 different months of what we call a time spread or a calendar spread, is where we saw, look, Google was priced now at the money right before earnings of 543. We're looking at the 545 call and put here, and you see the 545 call was at about 18 bucks. I'm just using the middle of this bid and this ask, okay? So about 18 bucks in the middle. and then you see on the other side about 19 bucks on the puts in the middle, a little over 19 here. So 18 and 19, 37 bucks. So you're talking about roughly about a 7% move in Google was expected just to see you break even if you bought the 545 call and put, what we call buying the straddle. Okay, now, from this perspective, if we look at this type of a situation and we say, okay, how do we take advantage of this? Well, I was telling people, look, I'm bullish on Google over the bigger picture there, but I'm not really that enthused about the short-term options pricing there. And I'm thinking it really looks like one that those things are positioned to implode. So I said, what you can do, well, first of all, how did I know that they were too expensive? Why is 7% pricing probably too high? Because a lot of people have very short-term memories. You probably noticed that, not just in trading, but in other aspects of life. People remember that last thing that they just traded, for example. You may do that yourself sometimes, where you just remember that last gain you had, or that last stop out you had, and that affects your mood. You should get to the point where that last thing shouldn't be the only thing that you're thinking about when you're placing your next trade. You should be certainly not so reactive, but rather consistent in how you execute your system. Now, and maybe we all need a little magnesium there, Richard, but bottom line is that what we're looking at is that most people were just remembering the big move that Google had in the October of 13 period, up about 10% from the prior day's close to the next day's open, 9.88% gap up. But you can see the other events before that were pretty much relatively small moves for Google on the gaps. So, and the one in October of 12, the stock dropped intraday because their company's printers actually reported their earnings a day ahead, earlier before that day's close, and the stock started dropping on that news. So can't count that one. But if you average those other 5 examples, you say your average is under 3% gain in this case. If you take away the plus and minus signs, you're still coming in around a 4% average gap. Just taking, an absolute value of these, about 10 plus about 4, about another 5 right there, and about another 3 right there, divided by 5, it gets you about a 4% average, absolute gap. Okay, so even if you think of it that way, you're looking at relatively expensive options. So I told my students at the time, in one of my workshops that I do, I said, look, this is an example of what I would do there then. I would sell those expensive April options, and if you're just looking at the at-the-money options, now I do something a little bit different based on the market expectations. But just for example, I was saying, look, if you sold that at-the-money call in April that's so expensive and you bought the May at-the-money call, that was going to cost you, as a calendar will tend to do when you sell short-term and buy longer-term, of course, on the same strike, you're going to have to pay a debit, in this case $630 a contract. You say, gee, that's expensive. Well, you know what? If you bought 100 shares of Google, that would cost you 54 grand in this example. So 630 bucks looks pretty cheap in comparison, at about 1.25% of the stock price, right? So the point of this is that, look, it's saying if at that April expiration that was coming up in that week, if this thing doesn't move at all, you see your position to make a bunch because you put in 630. Your maximum profit in the perfection scenario right at the strike price at 545 means that the April options would go away worthless. And the beauty of holding about a month out, give or take, on the longer options here, the May options, is that the May 545 calls have the most time value where? Right at the strike price. So that's your nirvana scenario. But the other aspect is, don't just think about nirvana. Think about all the other potential outcomes. If it gaps down, you can see a little under 510 at the April expiration as your break even, and here at about 585 on the upside. And you think 510 to 585, you could pretty much drive a truck through there with a stock finishing there at 545. Now, when you go back and you say, well, what ended up happening with Google? We were talking about that the stock was trading, as we said, right before that earnings period there at about 543. And you see it ended up settling down a little bit and then later popping back up a little bit. So it went down to about 518 right after the news and then popped up right there into the end of that expiration week up to about 557, finished at that last day there at 536. So if you look at that chart, you say, well, at 536, according to that chart, you're still going to be in a pretty nice profit territory of nearly a double against your $630 investment, making a profit of about that much as well. So, that's the kind of scenarios I like to create. And in this case, you can see this is off the Options House platform. Trade Monster merged with them, and they've had a really nice, clean way to look at it. This is not exact in its estimations, in my opinion, because it's not really factoring in the fact that, yes, there is an event coming up. And so sometimes you'll see, as we go through some of these charts, it'll show these super high win percentages when, in fact, yes, you could get an earnings gap that's bigger than what's expected. So we'll look at some of those. The other thing I mentioned before I go on to more of those examples is you can trade it after the gap, after the news comes out. And the tool that I like to use for that is my favorite simple tool that I would encourage you to take a look into. We teach you about a lot of these indicators in great depth. The Williams percent R, percent range indicator, we use it in a totally different way than what it was intended by Larry Williams. Most would call this an overbought, oversold oscillator, right? And yes, sometimes overbought can lead you to, if it doesn't follow through above the short-term highs, can lead you to the top of that market, But what we look for is, when something goes overbought and then it stays overbought, like this is Facebook coming out of that post-IPO period where Facebook had lagged for so long. When Facebook started to rally, that first breakout here, and then it broke out above that bar's high the very next day, this was actually giving you a breakout and what we call a retest right in front of the earnings, big gap up. Even if you waited till after the earnings, you still had other spots where you could hop on board on this one, buying the dips in the uptrend. This overbought market getting that what we call a retest right off of that black line there is another buy. If it doesn't close under that low, you've got another great opportunity, and you got yet a second retest after that earnings coming in, and then we would say get out right in front of the earnings, at least on half, if not more, to get your risk capital back, and then you got a little gap up, and then you get out if it starts to hook back down. Steve could tell you all about the candle patterns there that show exactly how the momentum after earnings didn't show what you wanted to see, and say, by that point you need to be saying didn't follow through. We have these bands as well. A lot of what we teach in the technical analysis side, but I want to talk more tonight about the earning strategy, and we can help teach you about new ways to look at technicals here as well. But this is an example on the way up. You can see, oh, by the way, that I didn't even mark it on this chart, but the next time it gapped again after earnings there in late January, you see the first overbought, and then what you do is you draw a line off of that high, and as it breaks out above that, it looks like it closed above it the very next day, that's where you get the initiation that it's not the top of the range, but actually has more potential legs to the upside. That one lasted for a little over a month. So earnings can be a catalyst for a big potential movement up, and in this case, here's one to the downside, Best Buy, BBY. You can see right in front of earnings, just seeing that first oversold signal. You know what, oversold, most of you think oversold is good. I say if it doesn't hold that support, it closed below it 2 days later, this one was setting you up for a potential problem after the earnings, and it even had what we call a retest where it tried to come out of that oversold area. That's a critical inflection point. Turns out that high resistance, if it closed above there, you're out of the downtrend. Instead, it's right in front of the drop that's coming into the earnings. You can then do your classic trend line analysis and such and see where you might consider lightening some of your position up. The traditional percent R would have said get out a little bit later. But you know what? In any case, you've really called the meat of the move into that earnings drop and beyond. Now, I'm going to tell you more about how you can learn about how I do this, my Big Trends Earnings Extravaganza alert service, but I first want to encourage you, because that's actually full up right now, and I'll tell you how you can get on that wait list. But in the meantime, I really encourage you to learn about this. What we set up is a special link here through bigtrends.com/earnings bootcamp. I know it's kind of a long web address there, but earnings bootcamp is what I've just started. I actually did my first session yesterday after the close, and I've got 2 more live sessions to go, plus we give you support in helping you as you re-review the material and watch the high definition archives as many times as you want for life then basically you get a situation where you can really get the support from me and my team about, are you understanding how to trade this earnings strategy? Now, this earnings strategy I'm going to actually tell you about here tonight that I've devised because it's just worked so well the vast majority of the time. A lot of people call these double diagonals, and we initially were kind of calling them that because that's the term that a lot of people know this by. But really, truly, most of what I like to do is what I call double calendar spreads. All that essentially means is that if you are looking on this chart and you're saying, you know what, if I thought GE was going to stay in a range between 23 and 25, I sell the short-term 23 put, I buy the longer, about a month out, 23 put, and I do the same thing overhead on the call side. I sell the short-term 25 call, I buy the longer term, in this case about a further month out, 25 call. Now those are real cheapies. You can see the net debit on those was just $12 a contract. Usually I won't do them that cheap, not just because you get a lot of contracts if you pay a commission based on the number of contracts that you trade, but also, obviously, that leads to a little bit more speculative position. The big home run for us in the January cycle, and we'll show you some of the April cycle as we had launched out the extravaganza service and some of the trades we did in May, even the Lulu trade we just did this past week. Show you some of those. But the big trade here, usually what will happen with these is that in each cycle you'll see some mostly steady gains, maybe a few smaller losses, and then you'll see one potential, sometimes two potential big home runs out of 10. So Google ended up, we had bought it as a double diagonal, buying the 490 put a little further out versus the short-term ones we sold, buying the 530 call. Google popped down, then popped back up. So, if you're looking at that one, for example, let's look at the chart real quick. That was January 29th. You'll see that, and again, we're talking about 2015 examples now. When you look at Google on January 29th, you see what happened here. Okay, that was January 28th. The earnings hit after the close. The stock was about 510. As I showed you, we had a 490 and a 530. That's about 20 points on each side that we were giving ourselves that wiggle room. And initially, the stock dropped. It had a negative reaction after hours, and it dropped a little bit that next morning. And that allowed us the opportunity to buy back that short-term call that we had, and we still had the longer call that was about to explode that next day. Look at what happened. Remember we had the 530 call? We had bought that back for like $0.25 when the stock was opening that next morning after the earnings at about 511. The earnings, the volatilities will literally implode if this thing opens flat. When they're expecting big movement, all those short-term options will get crushed. And we love that because if you've sold them high, you want to buy them back low. Or you sometimes can just let them expire and pocket that premium. But with Google, we know how fast Google can move, so we're very happy to buy the Google calls back, in this case, cheap. And notice, by buying the short-term call back, we're able to cash out and ring the register when it ran up here to 530 and change on that next day. I was blowing those further Februarys that I owned out. Now, I could have probably made a little bit more if I'd held on a little longer. You see it ran up a little bit further. But look, as the old saying goes, bulls and bears can get rich in trading, but hogs tend to get slaughtered. Sad but true. The reality is, you've got to have a strategy. You got to know how to manage it, and that's what we do for our subscribers here. And more importantly, since the earnings extravaganza service is in the short term full, but you can get on that waiting list. And in the meantime, you need to learn about how to trade this strategy. That's what the earnings boot camp's about. In fact, my very next class this coming week will be all about the double calendar and double diagonal strategy. And so you can see in this case we had a couple losers out of the 10, and then 8 out of 10 were winners. Some small, some medium, some big. But the bottom line is that you're looking at, okay, what could you do in a portfolio growth scenario? These examples are without commissions, so you should always take into account what your commissions are going to be based on the number of contracts you would trade for each of those type of situations. So if you're trading a dollar contract, obviously a GE one would get a little more expensive for most people versus all these other 5 and 10 lot ones that are pretty low commission overall. Especially when the other side goes out worthless on the short-term options, you don't even have to pay to buy those back. Now, I'm going to show you the more updated examples here in a little bit, but I want to just kind of give you a little more overview about how this double calendar and double diagonal can work. And what's the difference? The double calendar means you're dealing with selling and buying the same strikes in different months, different weeks, different time periods. The diagonal means you're doing different strike prices as well. And the reason I lean towards the calendar is sometimes the diagonal will require extra margin you have to put up. Typically, I like to avoid that. So I like to just say, let's just take advantage of the differentials in volatility as well as a faster time decay in the short-term options by selling those short-term out-of-the-money calls and puts and then buying usually about a month out in the same strikes for the double calendar. And so that will allow you to say, okay, you know what, if I review if the straddle's saying we're going to get about a 20-point move in either direction, then usually I'll give myself about 20 points up and about 20 points down from the current price to give myself what the market's expected wiggle room is. And then if it's beyond that, then we show our subscribers how to manage their way out of those trades if it's too big of a gap. But most of the time it's the same or less of a gap than what's expected. So you sell high volatility, you sell rich, you buy it cheaper. Okay, that's the basic idea on volatility differentials. Between the short-term high volatility, sell it, longer-term volatility, buy it. And the reality is you don't just want to sell high volatility by itself, because if the stock has a big move and say you were naked, which we never do, but if you were just selling premium and then it has a huge gap, much bigger than what you expected, now you have serious problems. So you don't want to do that. Be careful about how much time you have to wait until the expiration. Usually we like doing these mid to late week rather than early in the week, but sometimes we'll do them right at the beginning of the week if that's all we've got, and know where to pull the plug if you have to. Okay, so when you look at like the Google example I was sharing with you earlier, we were saying, look, sell these short-term Jan 30s, and at that time I was even willing, because the options were pretty expensive, but I said, look, I was even willing to buy another week out in the Feb 6s. That's why I had to be kind of quick to bail out of those Feb calls when the stock had that quick rally that next day in late January, because I didn't have that much time. Now I don't like to cut it that close. I found that was a little bit aggressive. I like to usually buy about a month out versus selling about a week or less out. Okay, so in this case you can see it was priced between a 240 to 340 debit. In the mid of that was like 290. 3 was a pretty fair price, but I think we used that higher 340 ask price when we put it in our track records there. So, and that 340, as I said, went to 1193 for the total position that we were able to cash out of. So that was a 250% gainer before commission. If you look at what that trade looks like, I call this the circus tent because, and I've heard that before. I don't think I'm the first one that's ever said that about a double calendar. But the idea is that, you can see the two peaks. The peak on the downside is because you sold and bought a 490 strike. So if it finishes right at 490 at the short-term expiration, that's your peak on the left. And you see in this case it's a little higher profit realized if it actually pops to 530. As we know, as I just showed you, Google did pop up instead of down. And so that was even more profitable for subscribers. Now you see it claims on the options house montage that it's a 100% chance of profit. We all know that nothing is perfect 100% probability, but it's basically telling you that these options are extremely expensive in the short term, which is giving you incredible wiggle room. In this case, down, it's showing you down to just under 470 at break even on the downside, or just over about 555 on the upside. That's an 85 point wiggle, about 40 plus points on each side. So that's pretty attractive, right? It gives you, in that case, the potential for the stock having been at 512 to say, 40 points, we're talking about an 8% move down or up to give you a lot of wiggle room. So we like that. And so, we look for these and look for seeing, and then, of course, even if the stock finishes dead flat, you can see, yes, there's a sag in the tent there in the middle, but that sag, as long as it's not too steep, coming back down close to break even would concern me. But you see in this case, it's saying even if it's flat at the end of the week, you're going to see the short-term options go away worthless, where you pocketed the full value of those. And yes, you're going to lose a little bit on the longer options you bought, but you're not going to lose as much as what you just gained on your short-term option sales. So that's what you do here. And a couple ways you can get on that waiting list, Bud. One is by when you sign up for the Earnings Boot Camp, you'll actually get priority access to our Big Trends earnings extravaganza wait list. And then you can also just call our 800 Big Trends line, even if not, and say you'd like to be on the wait list when spots become available. Hopefully they'll be available before the next earnings season, in more weeks. But we've been trading each and every week. So we do this strategy wherever we see opportunities here. You can see Apple. I had mentioned before Apple. I thought the options were cheap in that 2014 window. In this window, I thought they were just about right. You can see the stock was trading about 110.5, and we said, oh, look, you've got about 8 points on each side down to 102 or up to 118. Apple came out, of course, in that late January period there and ended up having a positive rally. You can see that it ran. Remember I said 118 from 110, about 8 points. Look at where it rallied to the day after when the earnings reaction happened. Look at the high of that day, 118.12. And it bumped and bumped and bumped around 118, and it got to 120, but it finished at 117.16. So the 118 call did go out with no value. So we'll watch that very closely. If we need to buy it back, we will. But otherwise, you can see what happened. We got a little bit of a continuation rally into the next week. I sold this one too soon. Still made just a few percent. I made 7.6%. I could have made a lot more in retrospect because the February options where the February expiration hit officially. It hit there on the 20th, and you can see that 118 call in the February cycle would have been worth a 129.5, worth 11.5 points. Kind of kicked myself on that one, right? Because that's going to happen where basically, you don't want to hold and then have too much risk because you're holding an aggressive option. You need to see it move quickly. It was a little slow at first. I said, I better protect my subscribers and myself and say, look, let's get out and take the small gain and move on. And we did. Akamai was one that I had liked in this window here in February. And again, Akamai was a name that I thought, we're looking at a pretty wide range. It was expecting about a 5-point move in either direction from 62. So it was going down to 57.5 up to 67.5. And you can see February the 10th is where we put that trade on. You see right there, right before the earnings, and this was a positive gap. Gapped a little that first day, and you had the opportunity to buy back your short-term calls, and then it started to really hum that next day. Got right to the strike at 67.5, and you say, look, even if you wrote it into the expiration on Friday, even if you held it, you'd have to buy back your short-term call for about $1.30, and your longer call was still worth more, so it still made about 57% from the entry at $1.30 to the exit at 205 on the net. So again, we do this with all of these different ones here that we were showing you. I've got tons of examples here of how these trades looked. The next one, first before I go to that, usually we were offering it in April at $995, but then as the spots got full, we said, look, we don't want to have too many subscribers in at one time. We don't want to have a hard time getting into trades. And so we said, look, you can call our 800 Big Trends line here and get on the waiting list. If you call it a night, you can just leave a message because Chris is outside the office tonight, but basically will be back in the morning. And Bud says, how far in advance do we enter these trades? We do them oftentimes the day before the earnings, Bud, because we want to make sure we get the pricing right to tie them in. So these are specific trade alerts. So we'll call out specific trade alerts for subscribers, and we call it BE square for Big Trends Earnings Extravaganza, the two E's. But basically, that's something that you, as a boot camp subscriber, you'll get priority waitlist access when the next spot opens up. But then, in the meantime, I want you to learn about it, and that's what the boot camp's about. Now, here's the updated track record on the closed trades. And I mentioned, okay, so we had that first January cycle, then we we had the relaunch, and interestingly enough, not every trade works. You see, we had a loser there kind of right off of the relaunch there that happened in April, and we did Intel at 42 cents. We had to blow it out on one side. We couldn't get out the other side, and we had to take 22 cents. That was a 47% loss. That can happen. We also had a loser on Solar City of about almost 50%. Okay, so I'm not telling you that all is rosy. And in fact, the hardest part is when you get a bigger gap than you expect. We had that happen once with Bida. Usually when you get a bigger gap than you expect, What I try to do is I try to buy back the short leg, which is now in the money, and then I try to trend trade the other side. Baidu flipped on us. We bought back when it broke to the downside, we bought back the short-term 205 put, and then we actually got burned when the stock rallied, and that's why it shows a bigger loss than what you put into it. So, in this case, 270, if it had gone to zero, that would be 100% loss. In this case, it was worse than that because, of course, we had to blow out the longer leg for less than we actually bought back the short leg for. So that one was not pretty. We did the same thing on LinkedIn, though, and we were able to make more than a double. So those kind of about balanced out. And the big home run here that made up for all of that was the very last one. Something about the last shall be first. Something about patience as a virtue and always work to cultivate it. This is AOL. I want to show you AOL especially here because I know I'm kind of tight on time because I've been showing you a lot of examples here. But we'll look at some more. AOL, you may remember. And let me just walk you through how these alerts usually look. And we're going to, in our earnings boot camp, which I'll get into in a minute, we're going to be walking you through all the nitty-gritty about how we come up and develop these trades, okay? But let me just show you real quick what we called out for subscribers back here when AOL. First of all, we'll look at the chart. AOL was about to report earnings here after the close there on May the 7th. And so you can see that was something where, okay, the stock's trading about $39.39 at the close. It had been to almost $40 intraday. And I was saying, you know what, AOL's had a negative history. However, this is what's beautiful about this strategy, by the way. The market's expecting about a 10% move on either side of $40, about 44 on the upside or about 36 on the downside. And so what I said is look, if you sell the 44 call in the short term, buy the longer 44 call, at the same time, you say, let's also sell the 36 put and buy the longer 36 put. And that was happening back there May the 7th. Let me show you this new trade. This is what these trades look like, by the way. So we said here, we send this out as an email alert. It also comes out as a text if you want to get it through text. But again, this is short-term close on the earnings extravaganza, but you can get on the wait list. And then I'll tell you more about how you can get to boot camp in the meantime to start learning about these trades. So you can see we were selling the second week May 44 calls. Essentially what's happening here is you're buying about a month out. You can see May 7th, and we're buying the June 44 calls, but then you're financing some of the costs of those out-of-the-money calls by selling the shorter-term, more expensively priced, higher volatility weekly options usually. As weeklies is usually where we focus because these stocks that have weeklies are more active. They give you more choices. And in this case, I didn't know which way AOL was going to go. I was in fact saying, look, it's had a little bit more history of down than up. It's had a couple times where it did move 10%, so I wouldn't be surprised to see it move 10%. But I said the beauty of this is the net debit, the net cost we were paying for this was $1.10. Which on a $44 or $40 stock is probably a touch pricey, but it was pricey for a reason, as you can see on this chart. Look at what happened. The stock did gap up, and you can see it traded intraday. This is the next day was the expiration of those weeklies on May 8th. Intraday, it did get a hair above 44, which made us a little concerned. So we actually said, you know what, we better buy back those short-term calls that are expiring that day when it's going over 44. We better go ahead and just hop out of those. I think we might have paid 10 cents on May the 8th. So we said, look, let's go ahead and exit the short call at 10 cents. There you go. So we'll give you very specific instructions if we need to get out of that short-term option. When we said get out of that May option that's expiring that day at 10 cents, and we did get filled on it when we have several brokers who can tell us if we're in or if we're out. So said, look, we bought them back there at 10 cents, okay? Then we're still holding that longer-term June option. Now, in this case, you see what happened the next Monday. The stock kind of stalled. I was trying to sell it that next Monday at a certain profit, and you see the stock didn't go a little bit higher that I needed it to. Sure was glad in retrospect that I didn't get out for the 50% gain I was kind of expecting, because then I walk in the next morning and before the open, it's been announced that Verizon is buying AOL. The stock had closed the prior day at 42.5. Remember, we have a 44 strike call that we've essentially bought now for 110 plus a 10 cents that we had to buy back the short-term call for. So we're essentially in at $1.20. You think of it that way, or you can take the 10 cents off of your net exit price up here. But bottom line is, once it opened up here at about $50.20, we said we know that that option's worth about 610 to 620. We got out at about 610, 611. I think was our average exit, minus the 10 cents we used was then the average exit price here, as you can see on the track record on the very bottom. 601 was the exit versus 110 on the entry. That was a 446% gainer. That makes up for a lot of ills, right? But bottom line is that still the win percentage is well above 50%, and we often tell people, look, to expect in the neighborhood of about 2/3 to 7 out of 10 of these to be profitable in this approach. Now, like I said before, I want you to get trained about how to take advantage of the double calendar strategy. So you see a few other examples here, like Amazon. Amazon, I think that was one of the few that we were wrong on in the January cycle. The stock gapped up too much, and we were still able to unwind Amazon and limit the damage. We lost 26% on that trade when the stock gapped up more than we expected. So even in a big gap situation like that, if you're nimble, if you get out, you don't hold and hope. There it was at the end of January. We were betting it's going to have about, in this case, a potential up to about 340, which is about 10% from 311, and it opened at 346. Its low was 340. We were buying it back into that little pullback towards 340, and thankful we did, because then it popped back up. So sometimes you're going to be wrong about that. It is going to be moving more. That's why you don't sell these options outright by themselves. There's a GE example, kind of a funky looking chart in that it didn't have a ton of profit there, but about a double from what you would be buying, every 10 contracts at 13 cents. We got in an average of 12, got out an average of 14. So nothing major there, especially after commissions. Home Depot, that was an unusual one in that the stock did gap up. We were right about the gap up. We gave it more room on Home Depot, and we still saw that the stock just stalled after the gap up. It still worked out to be a 60% gain for us. Hewlett-Packard was a loser. Hewlett-Packard gapped down more than expected, below $36. Quick exit again there allowed it to be a 17% loss. McDonald's was a small winner, about 20%. You can see that one's got a pretty tight circus tent there, a very tight range within a few points on either side. So usually we like to give ourselves a little wider points of profit and that sag that can still make you money in between. So the idea being that you want to create a wide range of scenarios. This is Visa, which ended up being a real nice one. It's only 17%, but it felt like it was going to be bigger when we put it on. Win was about 90%. The options were pretty expensive, and that's good. In this case, you're glad when the options are expensive because you're able to see a situation here in which thank you for the expensive options. I get to sell that very high premium here, okay? And so that really helps. So again, just reminding you what that track record looks like, and then saying, okay, so how do you start learning about this double calendar and occasionally double diagonal strategy, but bottom line is double calendar is a preferred strategy. And then also, what other things could you be doing around earnings season? And that's why I said we've set up this special page, and I'm going to show you the Lulu trade we just made as well. So we set up this special page for the earnings boot camp, and it's simple because it's bigtrends.com/earnings bootcamp. Okay, so bottom line here is that when you look at that, you'll notice that it just got started. And the earnings boot camp, you essentially are getting 3 different sessions with me. One that we just captured yesterday, it's now available on instant on demand. How earnings affect options pricing. The beautiful thing about this too is that whether you're watching them live or whether you're watching them and then need a resource, we give you unlimited email access to me and my team of researchers anytime you have a question about the strategies and the material that is presented. Okay, so you've got a constant ongoing resource with me and my team through that special email that we'll give you as a boot camp subscriber. You get all three of these classes, the one that we just archived plus the two live ones. The live one coming up this coming week is going to be on what I've started to overview for you. All of the ins and outs of constructing double calendar spreads to start profiting what I consider to be truly the ultimate option strategy for earnings season. Because if you know what you're looking for, and there's some very specific parameters that I teach my students about, you can really create a very high probability approach. You can see the short-term options oftentimes go away worthless, which you want when you sold those. And then you're left with relatively cheaper, about a month out options that you own for either the potential home run of the next AOL takeover kind of a situation, or even just a small trend move that gets you to a price target of 50 up to potentially 100%, usually in that window is what I'm usually looking for. And then the third session here is going to be all the other option strategies you can still do around before and after earnings. So you'll learn more about the trend trade. That's another favorite of mine, my favorite indicator setup with that, and how you can stick with those big catalyst moves when they start to launch up or down after earnings. You know, when you think about a stock like Netflix, for example, and you think, you know what, Netflix, right now it's actually just exited a long trend trade signal. But, you know, when you go and look at what happened to Netflix after the earnings and the fall through that happened, even if you say, gee, it looked a little late here, you know what, from 571, that thing ran up to more than 100 points while the market was going nowhere. You see, it did the same thing right after earnings last time, January 22nd, to buy at 410 on the way to 486 for about a almost 20% move in the stock over a 30-day window there. So, you know, this is powerful stuff. You can start to learn how to take advantage of those continuation moves after earnings in that third session of the earnings boot camp. Now, the earnings boot camp would usually be $299, so we've got it half off here tonight for you, and we're going to allow you to get into that all the way up until the earnings boot camp hits here, because it's not a problem for me with the training sessions to have as many people as possible. But as I said, the earnings extravaganza specific recommendation alerts you can get on the wait list, and you'll get on the priority wait list when you sign up for the earnings boot camp. We'll tell you when the next spot becomes available in the coming, hopefully, weeks before this prime earnings season in July here in a few weeks for the specific call-out trades that I do for my earnings extravaganza clients. Now, you want to learn first. Education should always be your foundation that you build on. And so the other thing I want to point out is that in addition to the earnings boot camp, we have set up a special, these are lifetime access boot camps, okay? So you can watch them straight off of our servers. They're very fast, watching them very quickly. And people, as you know, with me, I don't go slow. I don't go maybe hyper fast as I do in these webinars where I'm trying to jam a lot in an hour and maximize your time in our hour together and mine, but share a lot with you. But I give you a lot of different things, and these last oftentimes an hour and a half. The one I just did yesterday was right into about an hour and 25 minutes on just laying out all the elements of option pricing and how earnings affect different options in the money, at the money, out of the money, and how you can set up different strategies around earnings based on how the options pricing model works. It's a real eye-opener for a lot of people. Then we'll go into these specialty strategies like the double calendar spreads and how you can do that and essentially buy options cheaper by financing them with very expensive short-term options that you sell. So that's where you just hit the add to cart button to get the earnings bootcamp. But I wanted to point out to you this extra special thing that I just set up as basically a thank you to Steve and all in the Candlestick Trading Forum. We're usually all 7 of these. List price on each of them at about $300 a piece is over $2,000. It's about almost $2,100 for all 7 of these strategy boot camps. This includes not just the earnings boot camp, but all the other ones that I've recorded here in the last roughly 6 or so months. I mean, they're very fresh content that I've typically tried to capture. One on weekly options. So all you need to know to trade weekly options, and especially learning about things like option charts, which a lot of people don't know about. Swing trading boot camp. All the keys if you like to swing trade. Credit spread trading. I know a couple of you asked about that. How to do credit spreads and even iron condors as a third piece of that puzzle. Debit spreads is basically if you like to buy options but want to help finance them, kind of like what we're doing here in the earnings, but just a little different in the same expiration cycle. Debit spreads are a great way to go to lower your net costs. An ETF boot camp teaching you about all the ways to trade ETFs and ETF options. and then one I just captured on the Donchian channels. And this has been a very effective strategy for my Big Trends followers to actually take advantage of buying low at support, selling high at resistance, and letting the market and the stock define where the key support and resistance levels are automatically through the Donchian channel setup. I give you all the parameters, the indicator settings. So that's 1, 2, 3, 4, 5, 6, 7 different boot camps now, including the latest earnings boot camp. All of those together would be a couple grand if you bought them all individually, but you can get it tonight for just $495. And again, I'll honor that until the start of the next earnings boot camp session, which, as I said, is going to be this coming Wednesday, the 24th. Okay, so I'm a big believer in giving you a great value for education. You know that you can quickly pay for even the starter education with the earnings boot camp at $149 with just one more good trade, one more idea that allowed you to start cash flowing earnings situations rather than missing out on it. And then all these other ones that are in there for the $495, you'll see how you can add it. When you hit the Add to Cart button off of that page, by the way, you'll notice that we've already taken the lowest price coupons on there, so I can't apply any other coupons at these low prices. You're getting 3 different sessions. It'll end up being probably about 5 hours of content for $149. No taxes unless you're in the state of Kentucky, and no shipping because you get it on demand access immediately. So when you sign up, you get a members access page with your username and password. You can sign in, and then that's for just the earnings boot camp, $149. You hit the green checkout button, and you're good to go. And I'll just do it in the other best value example. If you get all 7 of the boot camp classes, that's 21 different sessions. That's more than 30 hours of content on all the strategies that I'll use across up, down, and sideways markets here for just $495. All you have to do on that one is just click any of the blue text there, left click it. And in this case, look at how much it adds. If you do the full boot camp regimen, as we call it, on the entire comprehensive 7 different boot camps, you would want to X out of just the earnings boot camp because it's already included at the bottom as the newest one of this boot camp package here. All those boot camps, all 7 of them, like I said, tremendous value would be $2,000 if you bought them all individually off of our website. Even 7 times the $149 rate that I'm doing on the one earnings one would put you over $1,000. You're saving big on it here tonight at just $495 all in. No future billings on these. You one-time investment, and you get lifetime access to one, or in this case, all 7 of those boot camps for just $495. Whichever one you decide to do, just go ahead and hit the green checkout button, and what that does is it pops you into our secure website order page on our shopping cart here, and you can see you just have to get your key information here in bold, and bottom line is that you'll see that when you get that key information in bold, that's for your credit card to be able to process. We take all the major credit cards, and now PayPal as well. Get all that in there. I know Chris has been in on the call with us. If he's helped you to get started, definitely encourage you to give him credit. And then you can also say, add me to the wait list. In this case, it would be the priority wait list for the earnings extravaganza alert service too. So from that perspective, you don't have to do that per se, because we'll basically consider all buyers of boot camps to get priority in the earnings extravaganza when it reopens. As I said, hopefully spots will be available here in a few weeks. Once you've done that, just click on the terms and conditions, and what you'll notice is that it's spelled out in full from this link. You can paste that into a separate browser if you want. This is not an auto-renew or anything. This is a one-time investment for education here, but it's a one-time investment that gives you lifetime access with the dedicated email that we provide to all boot camp and coaching students, so you can get any questions answered from me and my research team that are on your mind as you go back and review the material. Once you're ready to go, just hit the submit order button, and boom, you'll get the email that follows that once your order processes, which is fairly instantaneous, assuming you got your credit card details in there properly. Okay, so that's all secure through that special page, and you just go to bigtrends.com/earningsbootcamp. Let me go back, because I've been kind of walking you through this. Let me also say, good question from Latressa. What I do for boot campers is you do get a discount on the extravaganza service when a spot opens up as a boot camp subscriber. It depends on how much you've invested in the program in the past boot camps, but typically we'll credit up to half of your boot camp investment towards an annual subscription in the extravaganza service. Okay, so that's something you can work with Chris on, Latressa, after you sign up here, and then basically, obviously we want to make sure you get great value in the education first, because we're laying the foundation for you to be successful in trading earnings. And then when the earnings trades come out, you know exactly what we're looking for. And you can also learn how to find these kind of opportunities yourself. So that's what the boot camp will help you, is it'll be very specific and give you all the nitty-gritty, and you'll get me live for the next 2 sessions, where you can also ask me any question you want. I'll look at any stock you want. We'll be there as long as you want to make sure that we give you great value through any investment you make in Big Trends education. All right. If you can't come on the courses on Wednesdays, they are recorded, so you'll get the high definition HD quality access. Okay. So, Harry's saying, if we were doing Amazon earnings in July, now Amazon, of course, is coming out a little later. Let me show you one that we just did with Lulu. I promise you'll look at Lululemon, right? Lulu is one of the only ones I was interested in last week. And you can see Lulu was finishing on the 8th. They were coming out with earnings, in this case, on the next day's open. And the stock was basically pricing for a move up about, in this case, we were expecting a move about 10%. So from about 61.5, we were looking up to about 67.5. And we're also looking down to about 57.5. So we're looking at just a little under 10% when we put it out. The stock is about 62.5. It finished down a point. Probably a good thing in this case, because we'd sold the 67.5 call, and we had also sold the 57.5 put while buying further out. So in this case, we did that trade for $1.45 right there, debit. That means it costs $145. And then as it popped up, it didn't quite get through that 67.5 for more than about a couple of hours on the hourly chart. And we watch not just daily charts here, we'll watch the hourly charts real closely here as well and see, okay, are we getting the kind of confirmation? See, we got a brief little trend trade on the 15-minute chart for about half a day. But we didn't panic there, because then that ended and we said, look, now we're ready to kind of cool down here, and we did. So we kind of chopped around for the next couple of days. And then we were getting out right before the end of that expiration period at $2 versus our entry at $1.45. So that ended up being like a 36, 37% gainer for a couple of days' work. That's showing you Oracle, actually, but basically Lulu, there we go. Lulu was one here we see. There it is. The pop-up, then see how it settled back down, and that allowed us right in this settling period here as it climbed back a little bit to say, look, let's just say bye-bye and cash it in for that 37% gain here. You can see since it's edged back up, but it really wouldn't have done much sense on the 67.5 calls that would have been left over. So this is a big part of what we teach, is how to manage that. Let me go back and make sure I didn't miss any other questions. I'm a little bit over my hour time limit I tried to show you about. So you want high volatility for diagonals and calendars? Yes, you do, Tom. High volatility is good because it means that the shorter term options out of the money are going to be even more richly priced that you can sell. How far? Okay, we talked about how far in advance. It's usually right before the earnings. So, we knew Lulu had earnings that next morning. We're getting in there on the 8th. Okay, so this is the kind of thing that we'll watch and manage appropriately. So not every trade is going to win, but the idea is that if you don't win, you can usually manage these pretty well and get out quickly if they're not working. And so that's a big part of the job as well. We'll manage accordingly. Okay? Now, as I said, and Chris has popped it up there, all you have to do is you have to go to that page that we set up for you here. If you want to start learning how to trade earnings the way I like to, especially as you get into my next live session on the double calendars in super depth. I mean, we're going to go deep on those because it's by far my preferred earning strategy coming into earnings. I don't have to be right anymore about which way that thing's going to gap. I get all kinds of different moves that can gap up, down, or not hardly gap at all, and I can get a wide range, and you can get a wide range of scenarios here that can win for you while knowing how to manage trades on the rarities that will have a bigger gap than what was expected. So we'll teach you all about that and help you to really take advantage there. Like I said, all people that buy into my boot camp will also get priority access when my earnings extravaganza alert service for new earnings trades opens back up to new subscribers here, as I said, likely in a few weeks. So Ivy Crush does work for double diagonals. It works for double calendars. If you already have one of those existing classes by U66, check in with Chris. He'll help you because we are all about making sure, okay, if you've already invested something into Big Trends boot camps or Big Trends education, we typically give some credit towards that, towards upgraded packages. So we've got some pretty good rules of thumb on that, so Chris will walk you through that if you've got anything already. Okay, so we're here to help. And, you know, that's what, you know, Big Trends is on its 16th year. Launched the company back in '99, you know, after, you know, helping a lot of other people make money in the options markets throughout the 90s. And the beautiful thing is, you know, it's not the same market anymore as it was in the 90s. And yet there's so many opportunities still if you know what you're looking for. So I'm past my time here. I want to go ahead and wrap it up and say thank you for being with us tonight. It's been a lot of fun. I've tried to share with you a lot of the different things I look at into and after earnings, how to start structuring these trades. And when you sign up, whether you just get started with the earnings boot camp, which is fine, if that's in your budget, that's a great place to start because you're going to get 2 live classes in addition to the instant on-demand archive access of what I just recorded yesterday. And then, so you kind of kick you off here to soak that first class in, and then you'll be ready for the next couple of live classes each of the next 2 Wednesdays. And then if you want to then take advantage of the best value in getting all 7 of those boot camps, it used to be just 5 of them at $4.95 and people ate that up. Now you're actually getting 7, and we've kept the price low at $4.95. This will probably be the lowest and the last time that we'll keep it this low because you know, as we add any other future boot camps, obviously I can't keep the price that low because we've got so much already invested in it. But you're getting the benefit of that. Steve's been great to me, and it's been fun to be here with you tonight. So do take advantage of it. Go to bigtrends.com/earningsbootcamp, all one word there after the slash, bigtrends.com/earningsbootcamp. And Chris has posted there for you a few times there. So take advantage of it. Go through that process. Add it to cart on the 149, or if you want to get the full 7 boot camps for just the $4.95, just left click on the text like I showed you before. Then I've already got it in there once, so you'd have to X out of one of those 2. $4.95 gets you all 7 classes. And if you have questions on those, you can call Chris at our 800 Big Trends line anytime. So thanks, everybody. It's been a lot of fun. I wish you great trading into the upcoming earnings season and earnings that'll be throughout. It doesn't just hit 4 times a year now. We've got Nike next week. We've got Monsanto next week. We've got lots of different ones that we'll be looking at into next week and the week after, et cetera, to help you take advantage of that. So I hope you enjoyed it. Thanks for the kind comments. And back over to Steve and his team to wrap it up for tonight. Trade them well, folks, and we'll see you in one or more of the upcoming boot camps to come.
Thank you once again, Price. Excellent information. And here's the one thing I want to point out to everybody. When I was mentioning before that Price and I have been working together for a heck of a long time, if you think back, or at least I can think back through the years, I've probably gotten hundreds and hundreds of promos from different investment groups that would tell you the new secret and how to invest in the markets and make lots of money. And how many of those have you seen just come and go? Price has been around for decades, and it's based upon very simple experience trading that he's willing to share that with other people. So take a look at his information. I mean, Price is what I would call the kind of the bellwether of technical analysis. His information is as good as anybody, not as good as anybody. His information is better than most, if not everybody, out there on the internet. So take advantage of it. And with that, Price, once again, thank you very much. Your stuff is always very good information. So with that, everybody have a good evening. We will see you in the chat rooms.
Thank you, Steve. Good night, everybody.